Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is August 22, and I'm going to go over your three threes for the week. I'm going to go over our top three market movers and economic data for the week. I'm going to go over our favorite three asset classes and how we are positioned on the bonds and on the equities. So let's jump on in.
Okay, let's go over the top three market movers for August 22. Number one, we have a lot of good economic data coming out this week, and I'll go over that. Number two, we also have the Fed funds rate graph, and I'm going to dive into that and kind of go over that with you. And number three, we get the second revision for GDP, and then I also want to take a look at it, what it looks like moving forward. All right, we are on the home stretch of corporate earnings, and we also have some very good key data coming out on Thursday and Friday. All this week, though, we have earnings reports coming out from our tech sector, including NVIDIA, Salesforce, and Dell. And we also have some good retail companies like Nordstrom, Macy's, Dollar Tree, and Gap. So we got to see if we have a follow-up from the previous week, so some good earnings from these additional companies. On Tuesday, we're going to take a look at new home sales for July. And so let's take a look at them. On this graph, we have the white, which is the new home sales for the month. And the orange bars here are the recession indicators. This is the indicator by NBER, the economists that actually say that we're in an indicator. This is their call. So for July, the estimate is 575 new home sales for the month of July. Now, that's a 50% drop from the 2020 peak, okay? And so what that is telling us is that if we are to avoid a recession, this will be the largest drop ever and not go into a recession. So something doesn't add up. So either we are in a recession or about to head into a recession. Either way, it's not looking great. All right, so let's go back to Wednesday. We also have pending home sales and durable good orders for the month of July. And on Thursday, we have the second estimate, which I just went over, for our GDP. Last quarter, it came in at negative 0.9. Right now, the estimate is an uptick of 1/10 of a basis point, so negative 0.8%. We also have the start of the Fed's Jackson Hole Symposium. This is the first time since 2019 that the Fed members are actually meeting because of COVID. So on Friday, we also have the Michigan consumer sentiment, and that's take a look and see how the consumer's doing. But more importantly, we get our look at the Pce Price Index for July. And so what is the Pce Price Index? That's actually the Fed's best indicator. That's the one that they really look at. They even look at that one more than the CPI. So they're looking to see if that is peaked in June like the CPI. So this is going to be very important. And it just so happens to come out right before Fed Chairman Powell will give his speech from Jackson Hole on the economy. So we're going to get some really good data on Friday. So I anticipate the market moving somewhat on Friday. All right, so let's now go over the chart of the week. This is our federal funds rate. And the federal funds rate is the target interest rate set by the FOMC. Okay, and it's the one you hear on the media all the time about the Fed raising or lowering their interest rates. Well, that's what they're raising. Okay, and over the past 100 years, we've had three inflationary periods. We had World War I and World War II. Okay, so once the war ended, inflation came back down. We had the Great Inflation, which was the period from 1965 through 1982. This period right here, where inflation was in double digits, and the Fed funds rate was also up to 20%. Okay, so and then we also have the inflationary period of today and us in the 8 to 9% range. So the Fed raises interest rates for two purposes. One, they could slow down growth, and they have done that 6 times in the past 35, 40 years. Okay. They can also raise interest rates to slow inflation, which is exactly what they're doing today, but they haven't done that since the 1970s and the early 80s. Okay. So we've got to keep that in mind, and I'm going to show you why that's important. Okay, here's a graph of the Fed funds target rate, upper bound, and the CPI. Okay, and at the end of the last 8 prior tightening cycles, all the way back through 1974, and you can see that they had to raise interest rates, the Fed funds rate, above to finally get CPI down below it. Well, today it's the reverse. We have the CPI coming in at 9.5 and the Fed's fund rate, which is right now at 2.5. So what they have to do is their Fed's target is 2.0%. And if we take the next 4 Fed meetings and their rate hikes will get us up to 4, which will get us to where the CPI is now below the Fed funds rate. However, okay, I don't believe that's going to be as perfect as the next 4 meetings to get us down below 2% or get us even below 4. So in my opinion, I believe we're in the early stages or early innings of this inflation interest rate battle. Remember, the last one took 17 years. Okay, this is not going to happen in 17 days or a few months. So this is going to take some time to wash through the system. And again, keep in mind, this is something that we haven't done in the last 40 to 45 years. All right, so let's take a look at GDP now. The GDP comes out with this second revision, which I went over earlier, at negative 0.8 versus negative 0.9, okay? But here's some good news. The Bloomberg estimate Atlanta Fed have us positive the third quarter. So even if we were possibly in a recession, we are now, or at least as far as the estimates are concerned, coming out of the recession, at least in the third quarter. And in the fourth quarter, which is typically the seasonal best for the year, has us at 4.4. Okay. Now, but let's take a look at the first quarter and second quarter estimates, both negative. This is why economists say, yes, we're not in a recession today, but we are heading into one. Well, if these estimates come true, we definitely will be entering one in the first and second quarter of next year. So we've got to be careful there. But what we like to do is we like to smooth out the graph a little bit, okay? Because quarters can go up and down quite a bit. And so we look at it year over year. And what this is telling us is that the rate of change is still going down and still the growth part of the economy is slowing. So bottom line, the Fed is raising interest rates to fight off inflation into a slowing economy. The Fed has got to be careful here, and they can't overdo it too much or they will send this into a deep recession, which is why I said earlier from the one graph before, this is the early stages, early innings of this fight. So we've got to be cautious here. We've got to be careful, and we've got to keep our eyes on the prize here and understand that this isn't going to just fix itself overnight. Okay, so that being all said, let's take a look at the top 3 asset classes on a long-term basis. We have T-bills, US dollar, and utilities just came into the top 3. So that's telling us today that this market is still very defensive. And it's the primary driver of this market is defense. Okay, so keep that in mind on a long-term basis. However, let's take a look at a little bit short-term basis so we can see what's happening with not only equities, but also let's take a look at bonds. Well, as you know, we've gone over this graph many times, and we went to protect mode early in the year on a short-term basis and on a long-term basis. And now about 5 to 6 weeks ago, we started nibbling and buying bonds on a short-term basis, and hoping that this was signaling a bottom here. Okay, so far so good. Had a nice run up. Well, now it's starting to turn over. And again, if that keeps going, our process, which is a very systematic and dynamic process, will tell us get out. It's no longer good, and we'll go right back to protect mode on the short-term basis. On the equity side, I know this graph is a little bit busy and we go over it each week, but let's focus here over the past 4 or 5 weeks. And again, we did the same thing on a short-term basis. We were nibbling and stepping into selective equities on a short-term basis, or quote, renting them, right? And so far so good. The market's returned about 6.8 on the S&P 500. And I went over these ranges last week and said that this one, which was resistance, is now support, and now this one is resistance, and it bounced right off of that. And now, in including this morning's Fed futures were negative, it's now sitting in this support zone. So it's got a hold here, or our system will probably pick up, hey, it's time to get back out and go back to protect mode on a short-term basis. And if not, we will probably trade in here until we get some news that will take us either out or below it. That's it. Thank you again for joining us. Our next update is Monday, August 29th. So please don't forget to go ahead and subscribe, like, and comment so that we can get your feedback. And that's it for this week. So we look forward to seeing you next week, and have a great week trading.